Hi, my name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to actually a special segment. So I'm sitting here or standing here with Jordan Kimmel. We actually met on the set in Jersey, right? We were both doing a CNBC.
CNBC, yeah.
That's when Microsoft came out with the Kinect, which was a console which they've evolved from, and basically we were kind of like-minded.
We were in the same rock band, talked about stocks, relationships started. I'm glad it continued.
Yes, and we worked together for a while, and then we both, went our separate ways. And then all of a sudden, about 4 months ago, I saw him in an airport. Gave me his card. He's, out of town now. He came in New York. He's like, "Hey, RedDog, I'm in town." I said, "You know what? You've been watching the market for 30, 40 years."
Too long, long time. Lots of cycles.
Lots of cycles. So I was like, "Yeah, why don't you come in, do a video? Tell me what you're thinking and about where we are today, where we've come from, a little bit about what you're doing. We'll talk to a few sectors, a few stocks that he might like." And at this point, I just want to turn it over to Jordan and tell a little bit about what you've been doing these days.
Great. Hey, thanks, Scott. So, interestingly, I love the T3 group. I know it's a trading group, a lot of charts, really working on pivots. I think Scott really is one of the better traders. I love the group itself. I'm more of a fundamental investor. That doesn't mean a long-term buy and hold guy. I have quantitative models which rank stocks. And then it's the what to buy combined with charts of when to buy it. So I think what I'm most known for, Scott, is the magnet model. I've written a few books, been licensed to John Nuveen, had a really great career. But back in 08, I actually stopped managing other people's money in 06. It was a good time to stop managing other people's money. I started working on the FACS model, which I told you guys about, but it's a little different. It's more of long term. And what we've done with the FACS model is we've taken the magnet model itself and combined it with what some people call non-financials. We call them extra financials. It's accounting conservativeness, it's corporate governance, it's transparency of operations and sustainability. It's another acronym. We call it FACS. It measures, Scott, the most trustworthy companies in America. These are all large cap, mid cap stocks. We were seeded by a great institution, well-known guy, a little over 4 years ago. So we've been live with the model. We still are. I've set up an RIA where we manage both magnet and FACS. But I think there's an important message. When I saw you the other day on Fox, I was right on after you. It was a segment about long-term investing. What do I like? And I said, ironically, this isn't the right time in the cycle to think long-term.
Well, thinking long-term is different. Are you talking about like a guy who's my age, I'm 44? Why wouldn't I be thinking long-term right now?
Okay, so thinking long-term and acting long-term in the stock market. So I have a 23-year-old boy, just graduated college, has started to make money, and we're trying to say what stocks could he put away right now for 5, 10 years? And we're not in the right cycle for that.
Well, what I would say is if he's 23, why doesn't he just put in monthly funds in an S&P fund? Because he's 23, it doesn't matter what happens the next 5 years. He'll cost average into some kind of corrective phase if it happens, because over time the bull market wins.
Right. So, look, I've said in my last book, Magnet Method of Investing, for 90% of people, low cost, average funds, S&P funds will work, and you'll get your 8, 9, 10%. You compound that over 40 years, you do really well.
Very well.
But we're in this business because we think we're a little bit different. We think we could beat the market. And I just believe that there'll be a point sometime by next spring where pessimism will come in. And when you're 20%, 25% down, it's just a bad time to start like that.
So you're saying you think we'll be 20 to 25% down in September-ish?
Not September. I think that by the time next spring rolls around, I think there's going to be some pessimism that comes out. It hasn't been straight up like people say. The people say from 09, it's straight up and a monkey could have made money. That's not true.
Unless you put in money every single month in an S&P fund. But we know as market timers, and you're trying to be a market timer, that obviously timing and charts are what's key, especially if you trade for alpha. So like as you listen to him talk and the two of us talk, everyone has different time frames. I would say most people that watch this are trying to figure out how to, trade for the day, for 3 days, for, short-term trends, momentum trends, intermediate trends, and macro trends.
Right.
So if Jordan, who has watched cycles, is saying, what, we're in year 8 from the bottom, you're thinking we're close to some different type of cycle coming to fruition?
Well, when we look at the longer-term charts, you'll see how they change from the daily charts. But let me just kind of share very important, what I've always talked about in the short run. You can actually look at the market. That's not timing the market. People, like if you look up George Gilder, for you history guys, he actually talked about counts where he talked about when a bear market would happen. I don't do that. What I look at is the advanced decline line. I look at the new high, new lows.
Right.
Frankly, it's healthy as can be right now.
Right. So there's a process
right.
for a top.
Right.
So when we talk about process, like you guys all know, when I talk about the 8 and 21-day moving average, or I talk about the 50-day or the 200-day, what it means when we break them and how the trend changes, and then how the system or process changes when you stay below. Let's go to the daily chart, for instance, because everyone's been talking about when will this trend that started post-election end. So here is when it started. This is when it took out the descending channel here. This was your little anxious pre and election type of move that ignited.
Yep.
So we talk about the 8 and 21-day moving average. So here's your 8 and 21-day moving average that was basically intact for since November, and for the first time, it broke it, right? It broke it right around 2370. So you had your first move down. Now, if Jordan's thesis was correct, probably would have bounced up to here and kind of failed and went lower. Not catch the 50-day bounce off it and then hold it again, and now seem like it's looking to take out. Hold on, let's get it over here. This, right now this ascending trend line. Let's get that line back. Hold on, I think I might have just lost it. Where is that tool? Anyway, this was right here when it got back above, just say 2370.
Right.
So at this point, if you look at this chart, what in here is telling you that we could be down 20-25% in the fall?
Okay, and not a thing. Absolutely not a thing. That chart actually looks healthy. What you're seeing there is higher bottoms and higher tops. For folks that know me, I look at point and figure. We actually seen a couple lower tops and bottoms, but let me be really clear here right now. I am not saying this market is topped right here or is even topping right here. It's kind of like if you have enough experience and you are 1,058 like I am, what happens is you don't start a long walk in the woods at 4 p.m. The sun's out, it looks beautiful.
But there's a lot of people also have been saying since 2012, we're ready for a top. Okay. I'm not saying you've been saying it, and now we're in 2017, 5 years later, and either they've been short and losing their money and they're out of the trading business, or they haven't put their money back into a 401k and they haven't cost averaged in, and then they're never going to do it because they're always waiting.
And I'm not talking about, timing the correction. What I think we should do here, and we should do this for individual stocks too, look at what happens when you look at the daily time frame and change this all the way to monthly. Let's skip the weekly and go all the way to monthly if you can.
You want
to go to weekly first? Okay. So weekly first, what happens is clients have asked me, where's the support in this market? Where's the real good, strong, long-term support? And while you might look at the 21 right there.
No, that's momentum. This is momentum support. This isn't real. That's what my boys trade.
That's what I'm trying to talk about.
Right here. So 2320, that is when we go from trying to be in portfolio approach to tactical, meaning now that we broke the 8 and 21 day, you know what? You have a bigger support, which isn't even great support, closer to this, 22, actually it's a little bit higher, this 20, actually was a 2180 area where we broke out from. So this is your momentum trend. That breaks and you actually stay below it, you don't reclaim it, composure changes, you see leading stocks break down, you see other sectors lose their 50-day, stay below, then all of a sudden this would be your first step in a bigger process. And by the way, this is only about 7.5% from the actual all-time high, so that's not a heck of a lot.
Right, and that's not a lot. Now, by the way, remember we're looking at S&P. Today, by the way, the S&P's trading a fraction off its high. Small cap and mid cap have way different charts already. They don't look as strong as S&P. So I think what you have here, and this is really reminiscent of the four horsemen in the 2000s.
Dell, Microsoft,
Cisco, Sun.
Right.
These were companies where value investors threw in the towel. They said, I got to stay in business. I'm selling everything and I'm buying the four horsemen. Right. Now we have the FANGs. And FANGs, these are great companies with great stories. Valuation maybe a little bit differently.
Right.
I have a young kid who's brighter than I am. I put money into Amazon for him at his request.
How long ago?
Trade. About a year ago.
All right,
He's
so
doing well.
Yeah.
But the point is that
by the way, that's a really funny subject because usually the kids are more innovative and they know what's going on.
Exactly.
And they find like the Buffett approach where if it works for them, it's going to work for a lot of people, especially if you have normal common sense.
Right.
But so he wasn't an analyst. He said, "Dad, I love Amazon."
I like the future, and he's a futurist. He's a technology guy. He's a data scientist, and he says, "Dad, let me tell you what these guys are going to do. Get your old pants off and let me buy some stocks." I bought stock from him. I'm really happy. You learn lessons, but let me also mention what you're willing to pay for stocks in a bull market in a healthy trend is completely different than what you're willing to pay for stocks. When the advanced decline line came down, suddenly some pessimism comes into the market, and maybe even some bad news.
So that the beauty of what we do, is we're not, sitting on our hands. We're watching every day, so we get to see it. Not everyone is in that position. So I guess with what Jordan's also saying is that as an active manager, he'll be watching it for whoever his clients are. So he knows how to time it a bit better because, when everyone gets excited and everyone's talking about how it's never going to end, then they get in and then they don't know how to sell.
Right.
Or they end up selling at the bottom instead of having a long-term process. But anyway, if you go back to the S&P chart before we go on, I just want to show another level here because this is from the 2009 low.
Okay.
So you draw your trend line all the way up here, and that takes you basically to, what is that? That is right around, about 2020. So, this would be like I would consider your momentum trend. This would be your more intermediate trend, and this would be your more macro trend.
Okay. And what percentage down off there? That's close to 15, close to 20.
Oh, 2,400 down to 2,000. Yeah, it's not even that much.
Okay.
But anyway, so those would be, first thing happens, it's a process. This has to break and close below it, stay below it. This has to bounce off it, come back up, make a lower high, come back, break it, stay below it, and then that. And then if you really want to, start talking about like bigger, longer term, scenarios.
Okay, so let's look at a monthly chart now. Now show me where,
For some reason, I don't know why the monthly chart's not.
Okay, but that's a real long-term chart. That's all you need to see.
By the way, I remember when I was on with Kramer and I talked about the road to 1,700, and I was like, why do you say that? Why do you say that? I'm like, you take out a double top and you don't just stop. So anyway, you look at this like this too. Look how symmetrical that is. You had your double bottom low, okay, and then your higher low, higher low, higher low, higher low, broke out above a double top, gave you a big move. First corrective phase held the 200-day, came back up, consolidated, broke out. Now here we are again.
Yep.
So this is also why, on a 2% correction, you can't just get caught buying, because you never know. That's why we talk about a level versus a level when we have a process.
Okay, and then one other thing, Scott, I don't trade S&P contracts. What I'm doing is I'm in individual stocks.
Like in spiders,
well,
S&P funds?
I don't trade those. I trade individual stocks based on fundamentals, and I try to climb on board and hope I get to own them for 3 quarters, maybe 4 quarters.
So that's your time frame is like 3 quarters?
If I could. I mean, that means the stock has done really well for me. But the point being, I see the stocks that I own as good valuation, but the rising tide will lift the boats, and when the market, they come from the good girls.
I get it. And that's different too. So there's a way to do a long-term process, 401k for 40 years, 529 for 15 years. And then there's a way to invest with a manager that will do it for you with stocks, not your 401k, because it's different.
Right.
So your product, you said, what return has it done the past 4 years on
average?
Well,
the FACTS model has done just about 16% average annual return in very large, 37 billion is the actual market cap right now, average market cap. These are big, steady companies. A lot of them pay dividends, but they have price momentum. They've got the magnet behind them. And they rank up on the most trustworthy business model as well.
So it's like the IBD 50, something like that.
It's like the IBD 50, and I've learned so much from William O'Neill. The difference between William O'Neill and myself is he thinks valuation really doesn't matter.
Right.
And I think it does matter. I think you got to get around the track. You can't crash along the way to the finish line.
So if there's so you say 1 to 3 quarters. So if there was 2 or 3 names that you think that someone could have put in their IRA, you know, you give them a little bit of a treat, you know, what would the 2 or 3 names be that you think for the next 3 quarters they could perhaps buy?
Okay, so let me give you a turnaround right now. And so one of the big arguments is we don't make anything here in this country. And by the way, even as manufacturing comes back, there's not a single U.S. company that makes robots.
Makes robots, and the robots are making everything
Right,
else.
right.
So what makes the robots? Give me the symbols.
DDD is 3D systems.
That was an oldie but
Okay,
goodie.
but we say oldie, Scott.
Yeah, I mean oldie. Look at that. Look at that parabolic move that it had.
So let me share something with you. I could go back to my charts with clients buying this stock literally a couple decades ago.
Right.
Then it just took off a couple years ago, and it had a fantastic crash.
Yeah,
a fantastic crash.
Right, doesn't get much more. Like, look, by the way, that's a big lesson. And look at the moving averages above the 21-day this entire time.
Okay.
Peak, boom, boom, boom. But look at this lower wedge here. So let's go to a
if
daily
you didn't
chart.
hold this, if you didn't hold the stock on the way down, you don't have a rock in your stomach right now.
So
if you're
we call
stock,
it trash for treasure. Someone else's trash could be your treasure.
Okay, so what we've seen here is a couple of what I call fits and starts. The company's tried to get going and hasn't gotten going.
Right.
But what has happened now, the fundamentals have already turned, the revenue's turned. There's still a lot of bad taste on people with this thing. Whether it gets taken out. Now, GE has entered the business of 3D.
Right.
And they're not the only one, but they're the first one mentioned
I remember.
every single time.
What was it? It was
Stratasys.
Yes, SYS.
Exactly.
And there was one other one. Then there was a skin one, a skin grafting one.
Okay. This is the one I know. And what it is, when anybody mentions 3D manufacturing, this is the first name that comes to everyone's tongue. Now notice here,
you know, you got some support going across the like, are you in this already in your
I
magnet?
am in it.
You're in it? Okay.
I am in, and this is not a magnet stock right now. This is experience talking, where I like to come in. I'll show you one that.
Why is a magnet in this?
No, magnet is in it. What I'm saying is, as a portfolio manager, I have criteria, but if you have been around enough and you're willing to take a couple of percentage plays with companies, so this is in our portfolio to be clear.
Right.
This just doesn't have a super high magnet rank. 1 or 2 more quarters, by the way, of accelerating revenues and margins. All of a sudden, this thing turns around, breaks through 17, 18.
Yeah, you can see 22.5.
It'll be the talk of the town. I believe that I'm willing to own this stock based on its valuation and based on the fact that this is part of the future.
Yeah, no, listen, I know, you know, it got battered and bruised. It's been in consolidation now for almost a year, getting really, really tight. So technically, as a trade, it's probably not triggered. Like, it probably would be something that we start talking about if it got above 17-ish.
Exactly.
You know, but if you want to be tier 1 in an IRA versus that, and then it turns on as a trade, I'm sure they'll be back on my note at some point.
Now, let me tell you what I've learned from you guys, by the way, and I repeat all the time. People say, when do you get in? When do you get it? When do you get out? And you see people are frozen. Well, you do it in thirds.
Yeah, tier system.
You do it in thirds. So this you should. So I'm already in here. I'm not even with a very full position, but I will add to this
it's
at
in the
every
base.
level. And I really like this company. And so this is one I'd show for longer term.
Let me see SSYS just for 1 second. Yeah, same thing. You know, battered, bruised, long-term base down here. You know, just because sectors move together, it's below the 200-day at some point. You know, not to take away from Triple D, if this broke above that too, maybe it starts a fresh new
And then
new
the
trade.
group starts to act better. You want someone playing along in the group.
Of course.
So what we're seeing is something repairing. And so what they say, Scott, you know, from technical analysis and all, when you slip and fall down, you look around, see if anyone saw anything, you got up and run away. When you fall out of a 6-story building, like this did,
12-story.
you have to kind of crawl for a while. And it's this,
rebuild, get all the shares back in, tight hands, institutions.
So this thing is just barely crawling ahead. So let me just show you another one which surprised me by ranking out so high. And I mentioned this on the other day.
You're going to give them another one?
I'll give you another one, CLF.
Oh, we've traded that this year.
I would never, ever said 2 years ago, CLF looks like because you know, it's a coal company.
I hate coal.
And how could you believe in coal?
By the way, was it CLF? No, it wasn't CLF. No, FCX was on my report last year. This is this is CLF. Just to give a quick from 2016 bottom. You know, it's basically come off the crazy low when they thought it would be, I guess, bankrupt. Here's your little falling wedge right here, and it kind of changed and just had a big pull, and they had that money raise. I remember we were talking about the money raise up here, and it looked good and then failed. So right now, technically, to me, you know, I'm not, before you get into your spiel, because we all have, I'm not saying it's a spiel, we all have our spiels.
Right.
All right, the low here is 770, and that's the trend low off the bottom and above the 200-day. So now, why do you think this?
That's why I want to buy this. Okay, so here's what happened, and I said it on the other day on TV.
So you talked about CLF on TV?
I mentioned this on Liz's on Fox. Okay. But what happened here is, so her first reaction was, is this a Trump trade? She's talking about coal.
Right.
The reality is that you'd be shocked if you looked at quarter over quarter, year over year revenue. I don't even understand it. There's gigantic revenue growth in this company. I think maybe, and so what we all want is a narrative on why.
Right.
And we'll come up with a narrative in the future, but I will tell you that technically what this did is actually broke a downtrend. This doesn't have point and figure on it. It broke a downtrend.
Broke a downtrend here, okay, then it broke a few. If you go a little shorter term, here you had a nice gap up, and then it flagged, and then it continued. Here is when I think a lot of my traders were trading it, and then right there on the money raise, you had this big outside day, and that said, technically broken again, goes in the penalty box, stay away.
Stay away.
So now here it's back on the trend line for the bottom feeders who come back in, and that's like, you know, 7 and change. So here's
a bottom feeder on this one, because I really am, and I really am.
So if you bought it here, have you bought it yet?
I'm in it. I actually have a full position in here, and I'm up on the position. So it's all been bought, and I've averaged in, and I buy in tiers, and I sell in tiers. It's hard to believe I'm up on this position. But what's really cool is that the fundamentals are actually strong, and I don't understand it. And so what I'm doing...
Usually when I don't understand things, someone understands something more than I understand.
There you go.
You know, because the chart usually tells you. Same way they're like, how is Amazon still going up? They're not making any money. This was 4 years ago.
Right.
You know, oh, they're opening call centers. What are those for? No, but I hear you. But
so let me mention, I will use stops on everything. I do not average down.
So go back to this. So if you're in this stock, this breaks the 200-day moving average, and you're in a full position. Are you selling it?
I have to at least sell half on the break right there. Because I don't believe in coal. I really don't. I believe in my model, and I believe in charts. Both of them are pointing me to get in, so I'm in. And I actually have a full position now, but... Is
this your personal position, or this for the people that are in your fund?
It's not a fund managed accounts, so they're all invested in models. I have this in... Believe it or not, this ranks up on not only Magnet, but Facts as well.
Okay.
Because of their management, of all these extra financials. We buy all this data. They have a very, very high score.
All right. So listen, those are two names.
I don't want to argue with myself.
No, I'm not arguing with you. I'm not trying to be, I'm just giving you my technical fast eyes on it. You know, both of those names were trades that we've done on the virtual trade floor, trades that, you know, have been on my note. CLF was a fast mover like 3 months ago. Triple D, for 3 years, or 2 years, we were all over that. Mike Lee, if you remember him, it was his bread and butter with SSYS. And they've been put in the doghouse. I call it the penalty box, and that's when they rebuild. You know, all the people who don't care, who sell it for tax losses or sell it because they have bad memories, get out. New people get in, and then if the fundamentals get in there and they start to act better, then people look at it. But if you get in at times when nobody wants to touch it, you could have a little bit of room.
So before we show another idea, let me ask you.
No more ideas. We're running out of time here.
So where does this activate on a buy side if it would? Where would this activate?
It would have been right here. When it broke out, it would have been right here.
Now we got to pull back.
Okay, so right here on the 200-day, if you sold it on this outside day when basically it engulfed this whole upper range, that was your, this is broken now, and then it came in, went back to the what is this, the 8-day, boom, and now it's basically in a downtrend. So you could have done it two ways. You could buy it at the 200-day, which it came off. It's going sideways. It's showing some commitment to this. But I'll be honest, today's candle's an ugly candle. Looked like it tried to go. It's on the lows. Exactly. And if it starts to break down, I'd be very careful with this. This little scalp bounce trade, to me, is in jeopardy of breaking this.
Right.
Kind of like what this looked like. Boom, little bounce back, failed. Little bounce back, failed, and now we'll see what happens here.
I think that's a good technical call. I'm saying on the way back up through 10 on volume, what do you think?
Well, I would say, if you're in here, you're in here. I would say this could have been a spot. It tried to break above the spot. Same way in a whole different realm. You look at the spiders, and the spiders, ooh, look at that, it's turning into a topping tail. I got to get to my desk soon.
Okay.
But broke above this. So what this does is it squeezes shorts, gets people in looking for some kind of. Oh, is that 236? Oh, okay. Looking for some kind of bigger move, and then it comes in and kind of fells.
You want to get to your desk?
Yeah, I think I got to get to my desk and see what I have going on. I had some positions left over.
Well, the idea here, from my side, I'm not calling a top right here. What I'm basically saying is just like that tsunami that happened years ago.
Right.
And the water receded. Everyone thought it was a beautiful day to go deeper.
Right.
Guys with experience, guys who've been around through cycles said, hey, wait a second. This is actually a warning signal, not a wade into the water. Everyone off the beach.
Run like hell, get to your highest spot.
Okay, so I'm not going there, but what I'm saying is this is not the right time to start a long walk in the woods. This is not the right time to take 5-year positions and 10-year positions in names. So be careful. I'm invested, but I'd say be careful.
I get it.
Keep dancing, dance close to the door.
And if you're 75 and need your money, I would sell into this because you're going to live on it. It's like trade and live within your means. And we all know how to navigate short-term, intermediate, longer-term trends. Everyone does things differently. Jordan's been around the street now for 30, 40 years. I think he's had 1,000 hits on every different media outlet out there, so he knows what he's talking about. And hopefully, you learn something from this video. And I'll try and I guess I'll put you. Even though you're not that active on Twitter, okay, I will put his Twitter handle on there. So if you wanted to say hello to him and talk to him directly, you could do that too.
If this is helpful to your group, Scott, love to come back. I love T3. I love the scene here.
Sounds great.
All right. Thanks for having me.
Thanks for coming in.
Okay.